Have you ever wondered how the stock market works and how you can make money from it? Welcome to the fascinating world of stocks, a universe where the shares of companies are traded like commodities. Picture it as a bustling marketplace, but instead of fruits, vegetables, or clothes, here individuals and institutions buy and sell shares of publicly traded companies. Each share represents a tiny ownership slice of a company. When you buy a share, you're essentially buying a piece of that company. You're betting on its future success. As the company grows and prospers, so does the value of your share, and that's how you make money. But it's not just about buying and holding. The stock market is dynamic. Prices rise and fall based on a host of factors, from company performance to global events. This creates opportunities for trading, buying low and selling high. Intrigued? Let's demystify the process of investing in the stock market. To begin, we need to understand some fundamental concepts. Let's start with the term stocks. A stock is essentially a slice of a company that you can own. When you buy a stock, you're buying a small piece of that company and you become a shareholder. As a shareholder, you have a stake in the company's profits and losses. Now you might be wondering, what's a share? Well, it's just another term for a stock. Stocks and shares are often used interchangeably. Next up, dividends. These are a portion of a company's profits that are distributed to shareholders. So if you own stocks in a company that's doing well, you could receive dividends as a sort of thank you for investing in their business. Let's move on to stock exchange. This is the marketplace where buyers and sellers trade stocks. Some of the most well-known stock exchanges include the New York Stock Exchange and the London Stock Exchange. Now, onto bull and bear markets. These terms are used to describe how the stock market is doing overall. A bull market is when the prices of stocks are rising or are expected to rise. It's named after the way a bull thrusts its horns up into the air. On the other hand, a bear market is when prices are falling or are expected to fall. It gets its name from the way a bear swipes down. Lastly, let's touch upon the concept of supply and demand. In the stock market, the price of a stock is determined by how much of it is available. That's the supply. And how many people want to buy it. That's the demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. Now that we're versed with the lingo, we can move on to the actual process of investing. Investing in stocks is not as daunting as it seems. It's like setting off on a journey. You wouldn't just hop in your car and start driving without a destination in mind, would you? The same principle applies to investing. The first step on your investment journey is research. It's about understanding the company you're investing in. You wouldn't buy a car without knowing its make, model, or mileage, right? So why would you buy a stock without knowing the company's business model, its products or services, and its position in the market? Now, with the internet at our fingertips, you can find a wealth of information on virtually any publicly traded company. Look for the company's annual report, news articles, and industry analysis. They will give you a comprehensive picture of the company's performance and its potential for growth. After you've done your research, the next step is to analyze the company's financial health. This is where you dive into the numbers. Look at the company's revenue, profit margins, and debt levels. These indicators can give you insights into the company's financial stability and its ability to generate profits in the future. But numbers aren't everything. It's also important to understand the market conditions and the company's competitive position. Is the industry growing? Does the company have a competitive edge? These factors can significantly impact the company's future performance. Once you've done your research and analysis, it's time to decide how much to invest. This is a personal decision and depends on your financial goals, risk tolerance, and time horizon. Remember, it's not about putting all your eggs in one basket. Diversification is key. It's about spreading your investments across different companies and sectors to reduce risk. So, you see, investing is a process. It's about doing your homework, making informed decisions, and being patient. It's not a get-rich-quick scheme, but a way to grow your wealth over time. Remember, investing is not about making quick money, it's about making smart decisions. Now we've got our basics covered, it's time to strategize. Investing in the stock market is not a one-size-fits-all game. Different investors have different goals, risk tolerances, and time horizons. This is where your investment strategy comes into play. Think of it as your game plan, your roadmap to financial success. It's a tool that helps you make decisions that align with your financial objectives and risk tolerance. And two of the most common strategies are long-term and short-term investing. Long-term investing is all about patience and consistency. It involves buying stocks and holding on to them for several years, riding out market fluctuations. This strategy is based on the idea that over time, the stock market tends to rise in value, despite periods of volatility or decline. On the other hand, short-term investing, often referred to as trading, involves buying and selling stocks within a short period, sometimes within a single day. It's all about taking advantage of small, short-term price fluctuations. However, it does require more active involvement and can be riskier. Another crucial aspect of an investment strategy is diversification. This is the practice of spreading your investments across various types of assets to manage risk. If one of your investments isn't performing well, others might be doing great, helping offset potential losses. Risk management is another critical component of a successful investment strategy. It involves understanding and managing the risks associated with your investments. It's about not putting all your eggs in one basket and being prepared for market downturns. But remember, at the heart of every investment strategy is a clear investment goal. Whether it's saving for retirement, buying a house, or building wealth, having a clear goal can help guide your decisions and keep you focused. So, take your time, do your research, and choose a strategy that aligns with your goals, risk tolerance, and timeline. A well-thought-out strategy not only maximizes your profits but also minimizes your losses. Investing in stocks can be rewarding, but it also comes with its fair share of pitfalls. Picture this. You're about to embark on a journey into the world of investing, but you want to avoid the common stumbling blocks that trip up even seasoned investors. So what are these common missteps? First, let's talk about impulsive decisions. It's easy to get caught up in the hype of a hot stock, lured by the promise of quick returns. But investing is not a lottery, it's a long-term commitment. Making decisions based on emotions or hasty judgments can lead to regrettable outcomes. Patience and a cool head are your best allies in this game. Second on the list is the lack of diversification. Putting all your eggs in one basket is a risky strategy. If that one stock or sector takes a hit, your entire portfolio goes down with it. Diversification, or spreading your investments across different sectors and types of stocks, can help mitigate this risk. Next, we have the pitfall of not keeping up with market trends. You see, the stock market is not static, it's a living, breathing entity that changes with the times. Ignoring the pulse of the market can leave you blindsided by unexpected shifts. Staying informed about market trends and economic indicators can help you make informed investment decisions. Another common mistake is not understanding the company you're investing in. It's not enough to just look at the stock price. You need to understand the company's business model, its competitors, and its potential for growth. Doing your homework can save you from investing in a sinking ship. And last but not least, many investors neglect the importance of regular portfolio review. Just like a car needs regular maintenance, your investment portfolio needs periodic checkups to ensure it's still aligned with your financial goals. Avoiding these mistakes can make your investment journey smoother and more profitable. Remember, investing is not about getting rich quick. It's about growing your wealth steadily over time, and steering clear of these common pitfalls can set you on the path to successful investing. Investing in stocks is a journey that requires patience, diligence, and continuous learning. As we've seen, it's not just about buying low and selling high, it's about understanding the basics of the stock market, developing a solid investment strategy, and avoiding common pitfalls. We've talked about the importance of diversification, the power of compounding, and the value of long-term investing. We've also touched on the risks involved and the need to stay informed and adaptable in a constantly changing market landscape. Remember, investing isn't a get-rich-quick scheme. It's a disciplined practice that requires time, research, and a clear understanding of your financial goals. Don't be discouraged by initial setbacks. Instead, view them as learning opportunities. So, are you ready to embark on your investing journey? If you found this video helpful, don't forget to subscribe, like, and share. Stay tuned for more financial wisdom on our channel, Coinfluence.